Welcome back to Investing Talk Podcast. Today, we're plunging into what appears to be, well, a genuine financial enigma, PMAX. On one side, you look at the numbers, and honestly, some are rather concerning. A sharp decline in revenue, a clear shift from profit to net loss. Yet on the other side, its stock has recently kind of defied gravity. We've seen some truly surprising surges. It's a paradox, really. Makes you wonder what strange forces are truly at play here. Our mission today, as always, with the deep dive, is to sift through the data, connect the dots, and help you understand what's really driving PMAX. Why are we seeing such conflicting signals, and what should you, as a curious learner or maybe an investor, be paying close attention to? Before we dive deeper, just a quick note. If you're finding value in these explorations and enjoying our insights, please take a moment to subscribe, like, and maybe leave a comment. It really helps. And if you'd like to support us further, maybe consider buying some coffee. It genuinely helps us keep these deep dives coming. Okay, so let's pull back the curtain on the numbers.
The audited results for the year ended December 34th, 2024. They came out back on April 28, 2025. These aren't just a slight dip, right? They show a pretty significant drop. What are the key figures here that really jump out?
Well, what's truly fascinating here, I think, is the sheer scale of the financial contraction. It's quite something. In 2024, PMAX reported revenue of HK $36.5 million. That translates to about US $4.7 million. Now, that figure isn't just a decrease, it's a substantial drop. 25.7% down from the HK $49.1 million they saw in 2023.
Wow, 25.7%. That's significant.
It really is. This isn't just a slowdown, it's a sharp reversal of their prior growth. And it paints a clear picture of broader weakness impacting Hong Kong's capital markets right now.
Right.
And when we talk about weakness in capital markets, for you as a listener, that basically means there's less activity, fewer companies going public, less trading volume overall, just generally a more cautious environment for businesses in that space.
Okay, so it's not just the top-line revenue that's taken a hit then. The profitability story also changed dramatically. It swung pretty hard.
Precisely. The shift in profitability is even more stark, actually. For 2024, PMAX reported a net loss, HK $18.1 million, which is roughly US $2.3 million.
That's okay.
Yeah, and this stands in really stark contrast to the profit they recorded the year before. To put that into like individual shareholder terms, their earnings per share, or EPS, the profit per share, it swung from a positive HK $1.56 in 2023 all the way down to a loss of HK $1.37 in 2024.
Ouch.
Exactly. And as of the trailing 12 months, they remain unprofitable. Net income of negative $2.33 million, EPS of negative $0.18. It just means the company isn't generating enough money to cover its costs right now.
So no meaningful PE ratio either then?
Right. Because they're showing losses, you can't really calculate a meaningful price-to-earnings ratio. You can't divide by a negative number and get something useful for valuation in that sense. It just highlights the fundamental issue, no earnings.
So, okay.
Yeah.
We're looking at substantial operating losses, rising costs probably, heavy exposure to these broader market downturns in their specific niche. It sounds like a genuinely tough spot for any company.
It absolutely is.
Yet, despite these, well, let's be honest, rather bleak financial figures, PMAX's stock has told a completely different story recently. This is where that paradox really deepens, isn't it?
Mm-hmm.
On July 3rd, for example, shares closed at 0.49810. Okay, small gain, 0.769% from the day before. But that's just a ripple, right? Over the past 2 weeks, the stock has surged by approximately 41%, and with considerable volatility too. What's driving this kind of explosive, maybe even puzzling movement in the face of such tough financials?
Yeah, this is where the market's forward-looking nature often seems to disconnect from the immediate fundamentals, doesn't it?
Seems like it.
If we connect this to the bigger picture, the stock's recent behavior is incredibly notable. I mean, pre-market trading on July 2nd saw PMAX rise by about 20%, just like that. Now, this wasn't driven by any new sudden earnings strength, not at all. It was primarily fueled by positive sentiment, buzz, you could say.
Sentiment around what, though?
Around their recent strategic initiatives and just a generally optimistic outlook on their future direction. We saw a similar pattern earlier, actually, back in January 2025. The stock experienced a significant surge then, too, over 35%.
I remember that.
Right. That followed what was described then as an unexpectedly robust earnings report, plus growing speculation about an acquisition-driven growth strategy. Now, those earlier gains did moderate by mid-year, but this recent surge suggests that positive sentiment is taking hold again.
So it's clear there's more to this story than just the raw financial statements. It definitely sounds like the market is betting on something beyond the present number, something about management's direction, maybe.
I think that's fair to say.
What exactly are these strategic initiatives Powell Max is pursuing? What could be fueling this renewed, almost counterintuitive investor confidence?
This really raises a crucial question about how the market weighs different factors, doesn't it? Because even as they grapple with these current losses, Powell Max has been very active, especially in early July 2025. They're aggressively expanding their product offerings, for one, and strengthening partnerships with key industry players.
Okay.
There's also a clear, concerted emphasis on innovation, technological advancements within their service portfolio, trying to push into areas that might differentiate them in what's clearly a tough market.
Right. Trying to stand out.
Exactly.
Right.
And as you mentioned, that January price spike, it was indeed partly fueled by strong speculation about a very active acquisition-driven growth strategy. It suggests they're not just thinking about surviving, they're thinking about strategically growing, even in a contracting market.
So it's not just talk of a growth strategy then.
Right.
They actually have an active acquisition program underway. How does that work, especially for a company facing these financial pressures? What are they targeting?
Yes, this is a very deliberate and I'd say key part of their strategy. Powell Max is actively targeting smaller competitors.
Smaller how?
Specifically, those with annual sales, roughly in the $1 million to $5 million range. The aim here is kind of twofold. One, to rapidly expand their market share in what's a pretty fragmented sector. Two, to achieve economies of scale.
Economies of scale, meaning getting bigger makes them more efficient.
Precisely. For our listeners, think of economies of scale like this. As a company gets larger, it can often produce or operate more efficiently, lowering its average cost per unit of service. It's a bit like buying in bulk. The more you buy, the cheaper each individual item becomes, theoretically.
Got it.
And what's interesting here, and maybe a good sign for integration down the line, is that they are actively retaining acquired teams for continuity.
Oh, that's smart. Keep the expertise.
Yeah, it helps preserve client relationships, specialized knowledge. It's often overlooked but crucial. Their increased spending on sales and marketing also suggests a proactive attempt to defend their market share, maybe capture new clients, even while the sector shrinks.
So they're playing offense, not just defense.
That's a good way to put it. It tells us they're actively trying to shape their future, not just react.
Okay, that paints a clearer picture of their internal strategy. Now let's zoom out a bit. Powell Max operates in financial communications services, specifically focusing on things like financial printing, corporate reporting, translation, distribution, mainly for companies listed on the Hong Kong Stock Exchange. What does the broader industry look like? Are they just swimming against the tide here? Or are there underlying currents that could still favor them somehow?
The industry context is absolutely crucial for understanding Powell Max's position. You really can't look at them in isolation. They operate squarely within Hong Kong's corporate financial communications sector. And that space, well, it is currently experiencing significant headwinds.
Headwinds meaning?
Meaning strong negative forces pushing against them. These are largely due to fewer IPOs, initial public offerings, when companies first list on the stock exchange.
Right.
And just a general reduction in capital market activity across the wider Asia-Pacific region. So, yes, to answer your question directly, they are indeed swimming against a very strong tide right now.
That sounds tough. Are competitors struggling too?
Oh, absolutely. Their competitors are facing very similar pressures. It's an industry-wide issue. However, companies within this sector that are proactively investing in digital transformation or maybe expanding their service lines into new higher demand areas, those companies are generally viewed more favorably by investors right now. Which is exactly why Powell Max's strategic shifts like the M&A and innovation focus are so important. It's their attempt to be one of those companies.
So while the tide is out for the industry as a whole, some companies are adapting better than others. How does Powell Max stack up against its peers in this challenging environment? Are they uniquely struggling, or are they actually finding ways to differentiate?
Well, it's a bit mixed. While Powell Max has definitely carved out a niche leadership position in certain aspects of financial communications, it does trail larger regional players, companies like Aegis Media Asia and Lion Rock Group.
In what way? Size? Profit?
Both, really, in overall revenue scale and, importantly, profitability.
Yeah.
To give you a sense of the difference, Aegis Media Asia, for example, has estimated revenues somewhere around $10 million to $12 million, and crucially, it's profitable.
Okay.
That contrasts pretty sharply with Powell Max's roughly $4.7 million in revenue and its current net loss.
Right.
However, and this is key to understanding that market sentiment we talked about, Powell Max is trying to differentiate itself. Their targeted M&A strategy is very specifically focused on consolidating within financial communications and only within Greater China and the Asia-Pacific region. This specialized focus could, theoretically, allow them to become the dominant player in a very particular niche, even if the overall market is shrinking. It's a gamble on focus.
A niche consolidation play. Interesting. Okay, so what does this all mean for you, our listener, if you're considering PowellMax? Maybe as an investment, or just trying to understand this intriguing business case.
Yeah.
What are the major risks here, given this really unique situation? Financial struggles meeting strategic ambition.
The primary risks are, well, they're quite clear when you lay it all out. First, there's the very real risk of continued revenue contraction. If those broader market conditions in Hong Kong don't improve, or if their strategic moves don't yield results quickly enough, that top line could keep falling.
Makes sense.
Second, the company remains unprofitable, and that puts significant pressure on their cash reserves. It's simple math. If you're spending more than you're making, your bank account shrinks.
Right. Burning cash.
Exactly. If their operating improvements, the efficiencies they hope to gain from M&A don't keep pace with their revenue, or lack thereof, they could face liquidity issues, running out of money.
And the third risk.
Third, and I think this is critical, execution risk. Mergers and acquisitions sound great on paper, right? Expand, achieve economies of scale.
Yeah, sounds good.
But integrating new businesses, especially trying to do it in a declining market while you're already losing money, it's incredibly challenging. You've got cultural hurdles between teams, operational complexities, and just the sheer difficulty of actually realizing those anticipated cost savings while managing your existing costs effectively. It's much harder in practice than it sounds in a press release.
Those are significant hurdles, no doubt. What then should listeners be looking out for next from PowellMax? How can we tell if their strategy is truly taking hold or if the market's current optimism is maybe misplaced?
The next earnings release, that's going to be absolutely pivotal. It's expected around August or September.
What should we look for in that release?
You should be watching for concrete evidence, real numbers, showing that these recent mergers and acquisitions are actually translating into sustainable margin improvement. Are they genuinely becoming more efficient? Are costs per unit of service going down? Are they seeing actual revenue growth from those acquired assets? That's what matters.
Not just sentiment, but results.
Precisely. The social sentiment, as we've discussed, is currently quite bullish. You see it online, especially with news about their strategic initiatives, the focus on innovation. But caution is definitely advised regarding the sustainability of that sentiment, given the underlying losses. You have to look past the hype.
Good point.
Also, be aware of unverified rumors. Things about potential partnership announcements are apparently circulating. That stuff can always fuel short-term rallies, but you should always check official company channels for confirmation before acting on anything you hear.
Solid advice.
The fundamental question is, can they show that the why behind the market's optimism, the strategy, the M&A is actually translating into tangible financial improvement? That's the proof point everyone should be waiting for.
Okay. So given everything we've discussed today, the declining financials, these bold strategic shifts, the tough market context, and the stock's fascinating volatile ride,
Right.
what's the bottom line here? For our listener trying to make sense of it all, what's the pragmatic takeaway from this deep dive into PowellMax?
Well, based strictly on the current data, the analysis really leans towards a hold recommendation right now.
A hold.
Yeah. While PowellMax certainly demonstrates some sector-specific strengths, I mean, they do have recurring demand for their services from listed companies, which provides a certain stable baseline, even in tough times.
Right. Companies still need to report.
Exactly. And they have this active consolidation strategy we talked about. Those are positives. But the persistent lack of profitability significantly offsets that near-term upside potential from acquisitions or any organic growth initiatives they might achieve. The losses are just too big to ignore.
So the strategy upside is counteracted by the current reality.
Pretty much. And this raises a really important question for you, the learner. Can management truly execute these ambitious strategic shifts effectively enough to return the company to a sustainable state of profitability? It feels like a race against time, honestly. And investors should really await concrete evidence that this recent M&A activity translates into demonstrable, sustainable margin improvement before considering new positions or upgrading their outlook beyond that hold status. The potential might be there down the road, but so is the very real risk of an unfulfilled promise.
That's a truly fascinating look at a company grappling with intense market headwinds while trying, quite aggressively it seems, to reinvent itself through these strategic shifts. It perfectly highlights how market sentiment, often fueled by future hopes and narratives, can sometimes really outpace fundamental financial performance, especially in the short term.
Absolutely. It's a classic market dynamic.
So, what stands out to you from this deep dive? How do you weigh a company's bold strategic initiatives and the potential they might represent against the stark reality of its current financial struggles? It's a compelling puzzle, isn't it? Really demonstrates the complexities inherent in trying to understand market dynamics. Thank you for joining us for this deep dive. We'll be back soon with another exploration into the intricate and often paradoxical world of business and finance.